Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. Welcome to the Australian Investors Podcast. In this episode, I'm joined once again by Emanuel Datt from Datt Capital. I think this is Emanuel's third time on the show, which means that he's the only guest that has ever done that, which is fantastic. And in this episode, what we're talking about is one of Emanuel's favorite small cap shares. This is a kind of company that I've been following for a few years. It's got a market cap below $100 million, so it is one of those really small cap companies on the ASX. But before we get to that, Emanuel and I talk about, I guess, an update on the current environment and COVID and the rebound that we've seen in some parts of the market so far. But then Emanuel walks us through his process for finding growth companies. And particularly, I'm talking about companies that are tech companies or companies that have high returns on invested capital and reach that inflection point, or as Emanuel would call it, a seasoning. This episode, we talk about a few small cap shares. As always, just remember that Emanuel or myself may have a financial interest in any of the companies mentioned, and investing can be risky. So take our research and then go away and do your own, please. I hope you enjoyed this episode of the Australian Investors Podcast. Emanuel, thanks for joining me on the show again, mate.
Yeah, thanks for having us, Owen.
It's always a pleasure. This is part 2 of 3 of our stock pitch episodes, and you've been gracious enough to come back a second time. The first time was an interesting discussion. We talked about kind of being in the midst of a coronavirus, I guess, market downturn, and now a month later we've seen a pretty vicious snapback in certain sectors and with certain companies, which we'll get to throughout the conversation. So, Manuel, I thought a really good way to just introduce yourself would be to just explain kind of what the business that you've started, the fund that you run, and then maybe we'll jump into the different sectors, what we've seen so far over the past month and this month. And then I guess that will give us a good base to then talk about some stocks.
Yeah, sure, Owen. So Datt Capital run an absolute return fund. Our main point of differentiation is that we invest across multiple asset classes, and that allows us to express what we're seeing in broader society in the broadest number of ways. We are an all cap fund, so we can invest in both large cap, medium cap, small cap, all across the market spectrum. We've been quite successful in all sorts of companies, from growth to opportunities to mean reversion plays. We do the whole lot at our firm, and that seems to have let us perform. That's led us to some quite good outperformance versus the broader equity market.
Yeah, it's kind of this go anywhere approach, not only in terms of market cap spectrum from very small companies, and we've got a really small company we'll talk about today, but also then you can go right up to your household names like your Challengers and what have you. I think that places you well for a conversation about what we've seen right across the market cap spectrum. I know there's some stuff that you want to talk about with regards to the sectors that are of real interest to you, but maybe if I could just go back a bit and just ask you about how your fund has performed, being absolute return. I guess this is a pretty exciting time for you, or at least that's what I've kind of gleaned from reading your latest fund reports.
Yeah. So, I suppose, given the situation being experienced by the whole world at this point in time, March was a very difficult month for equity markets as a whole. Locally, the ASX total return index dropped 21%. The fund itself fell only about 13.5%. in comparison. And then, of course, this was followed up in April with quite a big whip back, with the total return index performance being positive 8%. And we've just finalized our April unit price, and we've actually achieved a 12% return in April itself. So it's quite, we think it's a pretty good effort on the part of our team to have outperformed both by negating the downside, but capturing more than the index on the way up as well. So we've outperformed both on the downside and upside, which is a really good effort from the team.
Yeah, I think that's the stripes that you earn as an absolute return fund, and that's kind of the position in a portfolio, in a diversified portfolio. That's where you want a an absolute return fund to kick in, and use that and really take advantage of that go anywhere approach. I know from talking to you off air that there are a number of opportunities that you're excited about. And one thing that we reflected on in the last episode was we talked about 3 companies being Challenger, and a REIT, which was 360 Capital. And then we spoke about Eclipse Group. And I know we spoke about potentially broadening the scope of this conversation to include maybe some technology shares and some opportunities in sectors that maybe, I guess, capture more of the capital light focus that indeed you spend a lot of time on. So maybe before we get to individual names or of companies, maybe you can take us through some of the sectors that you're most excited about.
Yeah, sure. I think one thing to keep first and foremost in the mind of any investor is to maintain the ability to be agile in this environment. I think that's really important. So in our last conversation, we talked about Challenger, Eclipse, and 360 Capital REIT. So we have actually we entered those positions, but now we've exited those positions at points where we considered that fair value was achieved. Mm-hmm. And I think that's it's very important not to get stuck or overly focused on particular opportunities that you may find in the market, but always be looking to find better opportunities where you may potentially earn a higher rate of return for your portfolio. So I think first and foremost, investors should have agility in mind in these turbulent times. But some of the things that we're sort of seeing or really interested in out there, the first recognizing the structural changes caused by the COVID-19 lockdowns. And I think something that we like to refer to is Maslow's hierarchy of needs, which is effectively a pyramid. So at the base of the pyramid, you have your basic needs. In the middle, you have psychological needs. And then right at the top pointy end, you have needs of self-fulfillment. So effectively, the way we picture it is that effectively broader society as a whole has been focusing on the basic needs. And those are the sort of areas that have really outperformed in this market. You can think of stocks like Coles and Woolworths that run supermarkets and sell other essential goods. They've really been a positive contribution to their shareholders' portfolios, I'd imagine, during this time, and they've actually appreciated over this time. So I think food and essential supplies has had its importance reinforced in a time where potential scarcity may arise or interruptions of supply. I think a few other sort of specific niches are services to supplement income from people that have been laid off given the economic circumstances. but also the importance of connectivity at home. Now that schools are shut down, people need reliable connectivity, to educate their children, but also have a connection with the outside world in a time of physical isolation. And that sort of flows through to greater demand for electronic devices, for example. And we've seen I've seen that JB Hi-Fi, for example, said that demand has significantly increased in their stores for these sort of electronic devices. I think that one factor that is very important in this environment is being focused on the low-cost provider in this environment, given that so many people are facing uncertain times in their own financial positions and the greater, broader economic environment itself. Yeah, and I think the key question for a lot of people out there is how to earn money while being under isolation if they don't hold a white-collar job, but they're subject to lockdowns. And I think that, in this instance, or this interest rate environment, investing your capital into a term deposit or a fixed income instrument isn't really an option anymore, given that interest rates are so low. So we think that, really the only practical way is for people with time on their hands to look into educating themselves on listed stocks, things that are, that you can earn a return from, but are also liquid enough that you can sell if you need the cash.
That's an interesting point you bring up, Emanuel. So one of the things that we do as part of our business, and I'm sure you're well aware of this, is one of the things that we do is educate people, and we do a lot of, obviously education around investing and personal finances and what have you. But what we've seen in our Google Trends and what we've seen from search results and analytics is that there's been a massive, massive uptick in people looking to educate themselves about investing, about ways to make money passively, all of these things that we talk about in any case, but now that's brought to the fore by isolation. People are actually looking, they're sitting in front of their computer and they're typing these things in, like how to buy stocks, I think was one of the most popular search trends in March. And it's kind of, it's a funny thing, but I guess there are companies, and we're going to identify one, or you're going to identify one, that is a beneficiary of this, right?
Yeah, exactly. And I think that, getting down to, I guess, a more granular level, I think a lot of investors who are coming to the markets, or perhaps revisiting markets that they haven't really paid attention to before, it's, I think, a big focus or onus for these investors is looking at growth companies, just because the returns that are potentially available is much more than investing in a major bank or one of the big resource companies like BHP or the like. So I think that I think growth companies themselves are probably quite a big focus for these new investors or investors that are coming back into the market now. And I thought that it would be a good opportunity to speak about a few factors that we look at when we sort of evaluate these sort of growth opportunities. And
I think I remember reading something from you quite a while ago now. It would have been around the time that you were starting the fund. You talked about companies like Afterpay. You did a big blog post on it, and you kind of got really stuck into the unit economics of it. You talked about, where incremental costs go and kind of the upside potential for that. So I think our listeners, not necessarily with Afterpay, but just kind of more broad strokes, how you think about valuing these opportunities and the things that you look for, the factors that kind of drive your intrigue into these businesses would be great.
Yeah, sure. So just having a quick trip down memory lane, I recall when we first published our initial sort of hypothesis on Afterpay, we was almost laughed out of out of town. I remember the AFR, were mentioned as having made heroic comparisons with Amazon, which enjoys similar unit economics. And I remember in that initial post that I made, I suggested that if Afterpay was listed in the US, it would trade between $25 and $50 a share. And look where it is today, at about $40 odd or the high 30s. So I think that we've been more than vindicated over time, which is a very short time, of only 18 months or so. So a few points that attracted us to Afterpay, but also this next opportunity that we're going to discuss. So I guess the first point was that to always keep in the forefront of your mind when evaluating these types of opportunities is that scale begets scale. And when I say that, I mean that the company can achieve a minimum level of scale to cover its fixed costs, and then really benefit from having a largely fixed cost base, and any extra growth can be supported by at very low incremental costs. So, or reduced incremental cost as it scales. So a lot of companies, they like to sort of portray themselves as growth companies, or pitch themselves as growth companies, when in reality, the addressable market may not really support their claim. So I think making sure the addressable market is as large as what's claimed is, but also the company's ability to scale or build that scale or capture that scale, whatever you want to call it, is really the number one key factor for us when looking at these sort of companies. The second that really is a key influence of this first point that I made is being the lowest cost provider with no strings attached. So we saw this with Afterpay. People were so befuddled and confused that here's a company that is providing an interest-free advance to customers, and a lot of people couldn't understand that business model itself was viable, because Afterpay actually charges the merchants, or relies on the merchants to monetize this product. So, but you can see, I guess, how much that increased demand from the consumer side, or user side, I could also call it. And I guess, with any sort of product that is free or very low cost, there's always going to be a very real opportunity cost to try out a competing product, for example. It usually doesn't happen. And if you can sort of couple this with really good customer service and a good user experience, it's almost like it leads to a positive feedback loop amongst users. So the lower cost generally leads to a higher rate of usage for the product itself.
Yeah, that's a really good way to frame it. The lower cost, is a selling point for it initially, and then feeds back in on itself, and then you double that with the customer service. We saw that, I guess, with Afterpay too, right? That there was, as it grew, and I think your modeling suggested this, as it grew, that customer acquisition cost came way down, but also the ARPU, or the average revenue per user, began to explode. So you get that kind of two-pronged positive effect on the financials, which at first isn't always obvious. Sometimes you do need to take a little bit of a leap. I wouldn't say it was a heroic leap by any means, but if you can identify that trend early, or those trends early, it can be very profitable.
Yeah, absolutely. And I guess it leads me on to my next point about company seasoning. By that, I mean, I'm sort of referring to the sense that, the duration of how long the company has been around for. So, and I think, it's an analogy that you can think of in the startup world. There are very few overnight successes. There's often, many years of hard work that goes into these products themselves. So, and just referring back to that positive feedback loop for users. I remember a particular slide that Afterpay put out in their presentation around their customer seasoning. So effectively, they found that the number of times a user used Afterpay was very, very strongly correlated with how long the user had been using the platform for. So I think from memory, I think if the customer had used the service for over 3 years, they were on average using the service about 18 times a year, relative, against if a customer had been using the service for under 12 months, it was only about 5 or 6 times a year from memory. So it goes to show, it's basically evidence that supports that thesis, I guess you could call it. And so I think that company seasoning is one other important factor that we look at, but also it allows, even though a company might look good very early on in its journey, we think there's always a risk that it sort of hits a hard ceiling in terms of user growth. So we tend to like opportunities that have sort of seasoned for at least 2 years or can show consistent growth over a 2-year period, just to reduce the risk of investing in the product itself. Because, as I said, a lot of products do hit a natural ceiling after a certain stage or point in time.
Yeah, that's a really good point. You can probably call it something else. I guess seasoning's a really interesting one. People talk about inflection points. People talk about, I guess, a whole range of different things in terms of like the value that's drawn out of different companies. So it's another thing that people look at is just the revenue retention, and how much revenue is growing year over year from existing customers is a really powerful thing. So a company on the ASX, and I know pretty well, is a company called PushPay, servicing churches with software, and it's well into that inflection point, or as you might say, it's seasoned itself for quite a few years now, and you can see the incremental revenue coming from existing clients is outstripping new clients, by a few factors. So I guess that's kind of what you're looking for, is that increased usage leads to increased revenue, and increased stickiness, if you like.
Yeah, absolutely. And, even in terms of user adoption, some people think that, okay, I don't want to shift to a particular service if it hasn't been around for a certain time, because who knows if it's going to be around in a few months' time, if it's not widely adopted. So I think that is a really important factor that not many people think about at all, to be honest, as you say. And I guess the last point would be that positive operating cash flow after a certain point. Because I suppose for, in these high growth situations, it's always very easy to burn up a lot of cash, trying to get to that point of scale where it does become profitable. And I think that the attraction is, in this instance, once it actually, a company reaches that point of of achieving positive operating cash flow is that generally these cash flows can be reinvested at much higher incremental rates of return. And, and it just goes back to that positive feedback loop, but in the financial sense this time. So, but I think that a lot of companies that we see tend to burn up a lot of cash trying to achieve that scale. So I think you just, as an investor, you have to have quite a clear idea about where exactly that point of positive cash flow and when it will occur, approximately. And I think the main point I'm trying to make here is that it can be seductive to try and get on too early onto an opportunity. But I think that if you have a clear idea about where you anticipate that point of positive operating cash flow will be achieved, then you've probably got a good idea about when to invest. If you really have no idea about when that may be achieved, then it's probably better to sit on your hands for a bit and keep watching. That's how we sort of think about it.
Yeah, absolutely. One of the things that, just coming back to that positive operating cash flow, is one of the things when you look at these, particularly SaaS style business, software as a service, or businesses that bank a lot of revenue into a subscription, is that oftentimes there's a deferred revenue account, because what happens is the companies can recognize contracts, or the companies can say, we've earned this revenue, but the cash isn't collected for a certain period of time, or there can be, a mismatch between what they're saying is like annualized revenue versus actual cash flow. So there can be a significant lag. I find this when I model these types of technology businesses. You find that there's, when you look at revenue and EBIT and those types of things, there's particularly, there's a lot of growth and you're banking in some assumptions, but then you notice when you get down to the free cash flow line that there's a bit of a drop off there, and you're wondering why. It's because oftentimes there's delay between what the company recognizes and what it's reporting. So it recognizes in cash flow and what's reporting in revenue. That's a really interesting idea. Emanuel, I feel like this is a fascinating conversation, but I feel like we should actually wrap this around a company and an idea, because there's a lot of people that are probably listening to this thinking, I'm pretty excited about this. Is there a company out there that fits the bill right now?
Yeah, sure. So one new opportunity that we've come across is a company called Selfwealth. That's listed on the ASX. The ticker is SWS. So Selfwealth, basically a broking platform with a unique product offering that offers flat price online broking and other sort of associated services. At this point, there are 4 separate revenue streams. So the main 2 being the discount broking, which is Australia's cheapest online broking. As an investor, you only pay $9.50 a trade, irrespective of the trade value, with no strings attached at all. And importantly, investors are able to invest under their own HIN, meaning that the stock is in their name. They hold the stock. And it's without paying monthly account fees or any sort of subscriptions. And the second revenue stream that is important to the company is the interest on client funds. So Selfwealth basically benefits from client funds on the platform by collecting an interest spread on the funds held within the platform. Also importantly, these client funds are held in segregated individual accounts, purely for the benefit of the clients themselves. So, and held with a Big Four bank. So it really reduces counterparty risk for clients. So you can sort of think about like Selfwealth as effectively the platform that's tying these services together. And they've got also another couple of much smaller revenue streams, subscriptions, where platform users can access additional features for $20 a month. That allows them access to trade and portfolio data, where they can be provided actionable insights. And also they have an ETF, so they get fees on an ETF that's ASX listed, and that at this point is these two particular streams are quite minor, so really not of importance relative to the broking and client funds revenue streams.
There are a few things here that I think are pretty appealing. So I think, firstly, we should acknowledge how small this company is right now. So, $40 million market cap. It's small by most standards. But also, you mentioned in a write-up that you did recently for it, which is really, really good, and it's kind of telling of the opportunity set, is the market share of this business. So, it's cheap in terms of broking. So I've looked at this for my personal broking quite a few times in the past. It's been around for a couple of years now, but it's cheap. It's flat fees. You can trade a certain amount. So there's definitely an appeal there for investors. But I guess the other thing to note is the market share of the business. So I'll let you fill in the numbers, but we all know CommSec, right? Because CommSec's it's the elephant in the room in terms of broking. But that said, we're still seeing a lot of growth from this smaller company. So I think that's a really interesting relationship, the size of the business versus the opportunity and kind of the share that it might be snatching.
Yeah, sure. So I think that, if we look at the market share split in the current Australian share market. So as you said, CommSec are sort of the gorilla in the room. They have about 50 to 55% of the market. And Self-Wealth, we estimate, have only about 4 to 5% of the addressable market at the moment. So we think that Self-Wealth can increase their market share significantly. They've actually been, prior to this COVID lockdown, it had actually been growing strongly year on year for a couple of years. For example, between January 2019 and January 2020, most of its key metrics grew by more than 100%. And, the effect of the recent sort of lockdown has been like pouring petrol onto a already roaring fire. We think, for example, in the recent March quarter report that the company put out, trade volume grew by over 100%, active users grew by almost 50%, and client cash on hand grew by over 150%. So, and bear in mind that this is just quarter-on-quarter growth. So very, very material and significant, we believe. And we actually think that, it's capturing a really significant number of the customers that are churning or changing between brokers. So we estimate that Self-Wealth themselves are capturing at least 25% of the current customers that are changing brokerage firms out there, relative to a 4 or 5% market share. So
that's a really interesting one, isn't it? If you were talking about a bank, you'd say it's growing well above system. That's something I didn't know. So that's really interesting because it is capturing, it's punching well above its weight in terms of new clients and also churning clients. So that's a really interesting one, Emanuel. I didn't actually know that. So I guess that's, if you can take that as, I guess, a firm variable or factor that you consider, that's very indicative of, upside potential, right?
Yeah. And I think, leading this back to the lowest cost provider in the market, since we have been covering the stock, we've actually received quite a bit of good feedback, from quite substantial private investors saying that, okay, we had no idea that this platform allows us to trade, at a fixed price of $9.50 for any trade value. So, and these are people that have, obviously they have the capacity to try all sorts of different solutions out there. And, if you're trading big clips of stock, in the hundreds of thousands of dollars, then the cost saving is actually very, very significant. If you look at it over a year, for example. So I think that has been a very big factor in its growth as well. And I think, a really huge attraction for us is that these are all external growth factors in terms of user acquisition and new clients and, the broader growth in the broking industry, at this point, this present time. But I think also the company has significant internal growth opportunities within its current product line that, they can be developed at very low incremental costs and will actually improve the product a lot. One example I can probably give is international trading, which they are planning on rolling out within the next 6 months. I think this is going to be sort of a really big step in terms of organic growth within its own internal client base, and also a couple of other things like multiple trading account functionalities and a new mobile app that's currently under development. I think these are 3 internal organic growth opportunities, I think will really increase the company's rate of growth, both in terms of users and in terms of trade volume itself. And all in a very compact time period as well, of about 6 months or within the next 6 months.
Yeah, so I've watched Self-Wealth for a while now. I saw them present in early 2019 or mid 2019 and had a brief chat with the guys at an event. And I got to say, I was really impressed by, I guess, the tools and that side of things. But I guess I didn't have the conviction around financials, and we'll get to that in a minute. We'll get to because I'm in my head, I'm ticking off all the 4 things that you mentioned earlier on. But I guess there was 2 things. Last night I was sitting up and I was actually in bed and I had my laptop and I was looking at actually opening a brokerage account with them because I'd held off in the past for a few reasons. But I'm one of the things that I want, obviously, is international trading. So I think that's kind of it'd be a lot of investors out there like me that are looking for a better international platform because, some of the platforms, I don't know what they're planning to do insofar as security and risk and all that. But when you invest internationally in Australia as a retail investor, oftentimes you get hiccups like you don't actually own the underlying stock, or your name's not on the register. You're just holding a derivative over the shares. You get all these weird and wonderful things that you don't really want to be part of. And then I guess the other side of that is where I noticed recently is this large advisor market. So Self-Wealth have pushed into that, where the advisors can come in and create accounts with users and what have you. By the way, I should mention, I'm talking pretty positively about this. I have no dog in this race. I don't own shares. I don't have a relationship with them at all. It's just an interesting business. And I just think there are quite a few different levers that, the company can pull or has already pulled, and they're just only now starting to gain that scale. So I think that's a really exciting aspect of the business too.
Yeah, definitely. In terms of financial viability and traction, I think that the company has sort of reached that inflection point in terms of financial viability. Our own reading of the quarterly financial statements was that March was their first profitable month, I'd say, given the historical accounts, or examining and comparing the historical accounts with the last quarter. And I think so I'm sort of expecting the company to be cash flow positive going forward, which is a really great way to be, because I think what is exceptional about the company itself is that to our knowledge, all the development is done in-house. So you're not relying on expensive contractors or outsourcing a lot of the core IP. So, it is like genuinely a fixed cost base, but at the same time, you get the benefit of having the capability to reduce the incremental costs of execution, for example, that really will flow straight through to its bottom line. So we are very excited about this, given all the factors at play here. And one thing that I thought is actually quite important to mention in terms of user growth, Owen, is that you referred to the research note that we wrote on self-wealth. If you recall, there was an Alexa site global website ranking measure, a screenshot that we took of that. From memory, the site's global ranking at the time of that screenshot, which was a week ago, was about 52,000. And today, 1 week later, it's at 47,000. So to jump, almost 5,000, to jump 5,000 places in the global web rankings, you would probably imagine that they are experiencing quite significant, consumer side growth or demand for the product itself. And often it's these little clues that can tip you off to growth opportunities before the company actually discloses it. It's all public domain information. It just requires a bit of digging.
Yeah, it's interesting, Manuel, because I think we think really similarly in this respect. When I was reading your report, one of the things that I do is that when I look for these technology companies, I look for leading indicators, any leading indicator I can get, mosaic theory and all that type of thing. But what I'm looking for is anything that gives me a heads up on financials. So like what I can expect in the next quarter or 6 months or what have you. And I guess the purest form of that is to go to where the product is. And, when I talked about PushPay earlier on, that's an app that churches can download. Well, you go to the App Store and you read about it, right? That's a very simple way to get your finger on the pulse. You look at downloads. Another thing, you can go even one step further up the stream, and you can look at web search history. So you brought that up about self-wealth. How many people are actually Googling this versus NabTrade versus Comsex? They're not even people that are registered yet. They probably haven't even downloaded the app. That's an even further, it's a better leading indicator if you think about it in terms of interest. But then you've also talked about Alexa rankings. And this is actually funny because for those that don't know, Alexa, you can go to Alexa, which is an Amazon company, by the way. You can go there and you can type in any URL you want and you can see how popular a website is and how it's trending over time. And so this is something that I use weekly for all of our websites and all of our products and services to see how are we going relative to our competitors. And to be honest, I was really surprised about how high self-wealth ranked in Australia. I hadn't even considered it as something that necessarily should be thinking about in terms of our business. So to see that and to see how it's trending, of course, there's a lot of noise over the last 30 days insofar as COVID and new user acquisition, time spent on site, all of those different metrics. But I was actually taken back by how quickly this is growing. And I think that was a really good insight you drew there, where you pointed to, hey, maybe this is more of a structural thing. Yeah, maybe we're bringing forward the adoption curve, and maybe this is actually a structural thing too.
Yeah. Well, I think that is the beauty of it because it's benefiting from multiple angles or parts of the thesis. There's the structural shift, which is a very important one, but also in terms of just achieving scale and like, for example, various marketing initiatives that are currently being undertaken by self-wealth. One of the very low-cost marketing initiatives that we really like is enabling referral. Like if a current user refers a new user, they get 5 free trades. So, it really costs the company about $20 or $25 from memory, in terms of hard direct costs. And for a new user, that you may potentially keep for years and years and years. That is really dirt cheap customer acquisition. And, we've seen, customer acquisition costs just literally drop through the floor. A couple of years ago, they were running at about $700 or $800 customer acquisition cost per customer. And that's really just fallen like a stone. And that's where the benefit of scale is, because you're getting strong word of mouth referrals. But these sort of referral networks are not possible unless your product is doing the job that it's meant to. So one interesting factor that we noticed is that during the recent market volatility, the two major platforms, CompSec and NabTrade, were struggling with the weight of demand, and as such, they were down for large parts of the trading days during March and April. So whereas in contrast, the self-wealth platform didn't have any issues that we're aware of. So it really goes to show that if you can deliver service reliably and service your customer needs adequately, then half the puzzle is already solved right there. Itself.
Absolutely. And during those times of market volatility is when you want your broker to be reliable and have uptime, right? So that's really important. Emanuel, conscious that we've been talking this for a long time, quite a while now. I think a really good way to kind of put a bow on this is just to talk about, I guess, just recap on where you see opportunities. I know that you recently, took a stake in Self-Wealth for the fund. I imagine you're pretty excited by what comes next, not only here, but with other opportunities.
Yeah. So I think that, the market in its current state is throwing up a lot of opportunities. I think what's important for investors to remember is stay agile and look at a lot of opportunities. I think that would be sort of my main suggestion, that try and broaden your own horizons and understanding, and you'll come out of the other side a much better investor. I would probably suggest that also investors still don't be too aggressive in your investing. I guess that there's a lot of opportunities out there at the moment. You've just got to pay attention to what's happening in front of you, and just remember that the situation that we're currently in isn't going to last forever, and life will go on. So,
Great advice. What I'll do is I'll put a link in the show notes to the piece that you wrote up, so people can get if they're looking for any of the facts or figures that we spoke to in some of the charts that you mentioned, they can get that in the show notes and see how you've come to the conclusion you have on Self-Wealth. But Emanuel, it's always a pleasure. I'm looking forward to having you back on for round 3. I'm interested to see where we go. We went from Challenger-esque style investment ideas right down to a small cap or a very small company in Self-Wealth today. So again, I'll just say, how can people get in contact with you?
People can get in touch with us via our website, which is datt.com.au. Just the contact form is the best way to get in touch with us for any queries or feedback.
Yeah, great. Wonderful. Again, I'll put links in the show notes. But Emanuel, it's always a pleasure to have you on the show. Thanks for joining me.
Yeah, thanks for that, Owen. Cheers.